All right, let's talk about oil. Because if metals are telling you how people are feeling about trust, oil tells you where pressure actually shows up in the real world. If you're new here, I'm Paula, and on this channel is where we step back away from the noise and try and understand what's actually happening underneath the markets. Not just crypto in isolation, but how crypto fits into a much bigger global picture that includes commodities, geopolitics, liquidity, and power. And oil sits right at the centre of that. Oil isn't abstract. It isn't something you can just park in a portfolio and forget about. Oil moves the real economy. It moves food, transport, manufacturing, defence, and energy security. When oil is under pressure, everything else eventually feels it, even if it takes time to show up. What's interesting right now isn't that oil prices are exploding higher, it's that they're refusing to relax. They're sitting in this uncomfortable range, and markets are quietly trying to work out whether that discomfort is temporary or structural. On the surface, oil looks manageable. Prices rise on one headline, slip on another. A winter storm knocks out US production, then input comes back. Nothing that screams crisis, and because of that, a lot of people assume the system is basically fine. When you stop looking at oil as a price chart and start looking at it as the plumbing behind it, a very different story emerges. Oil right now is not pricing abundance, it's pricing fragility. Oil markets don't wait for supply to disappear before reacting. They price the probability of disruption. That's the key thing to understand. It's not about whether oil is flowing today, it's about how secure that flow really is tomorrow. Geopolitics plays a massive role in that. The Middle East remains a constant source of background tension. Iran doesn't need to shut off supply completely to matter. Shipping routes, insurance costs, sanctions enforcement, naval positioning, all adds friction. And oil prices respond to friction long before they respond to outright shortages. But the oil story right now isn't just about the Middle East, it's also about Russia. And this is where things start to get more uncomfortable. Russia is still producing oil. Barrels are still flowing. So on the surface, it looks like supply hasn't really been hit. But dig a little deeper and you see that Russian oil is being sold at huge discounts. In some cases, close to 50% below global benchmarks. That's not a sign of strength. That's a sign of stress. When a country has to sell its main export at those kinds of discounts just to keep it moving, it tells you that the supply chain is functioning, but it's under strain. Financing is harder, insurance is harder, logistics are more complex. Profit margins are squeezed. In fact, Russia's largest private oil producer has been seeking state support because selling oil at those discounts makes it difficult to operate sustainably. Assets are being sold. International stakes are being restructured. Companies are being pushed closer to the state just to survive. This matters because it shows you that oil supply today isn't simply on or off. It's flowing through a system that was warped by sanctions, politics, and rerouting. And that oil doesn't disappear, it gets redirected. A lot of discounted Russian crude is going into countries like India and China, where it's refined and in some cases re-exported back into global markets as finished products. So supply exists, but it's moving through a much more fragmented, inefficient, and politicised system. And inefficiency isn't inflationary. Now let's talk about Venezuela, because this is where a lot of narratives get dangerously oversimplified. Venezuela has the largest proven oil reserves in the world. And yes, the United States now has significant control over Venezuelan access through sanctions policy, licensing, dollar clearing, shipping insurance, and enforcement power. The US effectively decides who can operate, who can export, and who can get paid. But here's the crucial point. Control over access is not the same as control over production. Having oil in the ground does not mean you can produce it at scale. Venezuela's oil industry has been hollowed out over decades. Infrastructure has deteriorated. Pipelines, refineries, storage facilities, export terminals. Much of it is in poor condition. Skilled labour has left the country. Capital investment dried up years ago. And much of Venezuela's oil is heavy crude, which requires specialist processing and dilutants just to be usable. Even with US licenses in place, even with political permission to operate, you don't just turn the taps on. Rebuilding oil infrastructure takes years. It takes tens of billions of dollars. It takes legal clarity, political stability, technical expertise, and confidence that contracts won't be torn up overnight. Markets understand this. That's why oil prices don't collapse every time Venezuela's reserves are mentioned. The market doesn't price oil on what exists on paper. It prices oil on what can actually be produced, transported, insured, refined, and sold reliably. So when people say the US controls Venezuelan oil now, so supply will increase, they're missing the reality that oil isn't software. You can't just deploy it. This is why oil remains stubborn. Then you layer in something much more mundane, but just as important, weather. Recent weather storms in the US knocked out a meaningful chunk of production and disrupted refining. Those barrels will come back, but inventories, delivery schedules, and trader psychology don't reset instantly. Oil markets remember stress. So what you end up is no single shock, no dramatic collapse, but layer upon layer of friction. That's how oil pressure builds up without screaming about it. Now, halfway through this, I want to take a second to mention something we've been building alongside all of this analysis, because it's very much connected. I co-host the UK Crypto podcast with Milkshake Matty, where we look at crypto markets and macro through a UK lens. Weekly episodes are available right here on YouTube, so you can search UK Crypto Podcast or you'll find the episodes linked directly through my channel. The reason I mention it here is because these conversations matter. Crypto doesn't exist in a vacuum, and understanding how global energy, liquidity, and geopolitics feed into markets is exactly what we spend time unpacking on the podcast. Now let's bring this back to why oil matters for markets and for crypto. Energy prices feed directly into inflation expectations. Not just inflation prints, but expectations. And expectations are what shapes behaviour. If businesses expect energy costs to stay elevated, they pass those costs on. If households expect fuel and heating bills to remain high, they change patterns of spending. If investors expect inflation to be sticky, they demand higher returns. That pushes bond yields higher, that tightens financial conditions, that drains liquidity. And liquidity is the oxygen for markets. When liquidity tightens, leverage comes out. Correlations rise. Assets that used to move independently suddenly start moving together. Crypto sits right in the middle of this. In the short term, oil-driven inflation pressure is a headwind for crypto. Tighter financial conditions make speculative assets harder to hold, volatility increases, and pullbacks become sharper. But just like with metals, there's another layer to this. Energy has become political. Access, pricing, and reliability are shaped less by pure market forces and more by geopolitics and power. And when essential resources become politicised, people start questioning centralised systems. That doesn't mean crypto immediately pumps. It means the reason crypto exists becomes more relevant. And this is also why self-custody matters so much in periods like this. When systems feel fragile, when liquidity tightens, when geopolitics starts influencing markets, counterparty risk becomes real. Exchanges can freeze, withdrawals can be delayed, and rules can change overnight. That's why I personally use self-custody, and that's why I've partnered with Tangem. It's a cold wallet that I genuinely like because it's simple, secure, and doesn't rely on keeping your assets on someone else's platform. If you're navigating markets like this, understanding where your assets actually live matters more than ever. Tangem currently have discounts on their website, but if you also access it through my link or using the additional discount code Paula, you will get an extra 10% off. I've linked it in the description of this video. Oil right now is telling us something very simple but very uncomfortable. The global energy system isn't smoothly balanced, it's fragmented, it's politicised, it's being rerouted, discounted, sanctioned, subsidised, and stressed all at once. And that pressure doesn't stay in the oil market. It leaks into inflation, policy, liquidity, and risk assets, including crypto. For retail investors, this is why oil matters, even if you never trade it. Oil is one of the fastest ways stress moves through the system. It changes the backdrop quietly, often before the headlines catch up. You don't need an oil shock to feel its impact. You need oil to stay stubborn. So when you hear stories about discounted Russian oil, US control over Venezuelan access, winter storms in the US, or Middle Eastern tensions, it's not about which headline is bullish or bearish. It's about recognising the pattern. The pattern is fragmentation. The pattern is inefficiency. The pattern is pressure. And pressure changes how markets behave. Before I wrap this up, I want to say this. Navigating markets like this can feel incredibly isolating. When narrative shifts and volatility picks up, it's easy to feel like you're on your own, trying to make sense of all of it. That's exactly why we built the Crypto Wolfpack, a community where normal people can connect, share perspectives, read charts, talk macro, and not feel like they're guessing in the dark. And if you want to know the exact strategies we use in the Crypto Wolfpack to make money in both the bull market and the bear market, we've made a completely free course for you. The link is in the description below. If this video helped you to understand what's really going on beneath the surface, give it a like. It genuinely helps the channel. Subscribe and turn on notifications if you want more of this joined up thinking, because what's happening right now is significant. And understanding context matters more than speed. You don't have to navigate this alone. And before you go, I'd genuinely love to know how you're reading this. Do you see what's happening in oil as temporary pressure, or something more structural that's going to keep feeding into markets? Let me know in the comments, because I do read them, and a lot of these future videos are shaped by the questions and perspectives you bring into this space. If there's a specific angle you want me to dig into next, whether it's energy, currencies, Japan, or how this all feeds into crypto, tell me. This is very much an ongoing investigation, and the more we talk through it together, the clearer the picture becomes. Thank you so much for watching, and I'll see you in the next one.